From the morning reading, European equities hit a 16-month low early Monday morning, extending the previous week's hefty losses, with cyclical sectors such as banking and automobiles bearing the brunt of the broader sell-off. The FTSE Euro First 300 index of top European shares fell 2.1% to 1256.3 points by about 1 o'clock GMT. After falling down to 1252.2, its lowest level since October 2014. The Stoxx Europe 600 banking index, down 2.6%, was among the top decliners. The index is down more than 16% so far this year on concerns about bank earnings and profitability in a negative rate environment. The cost of insuring European financial sector senior debt against default also climbed to its highest level since late 2013. Shares in Deutsche Bank, Commerzbank, Credit Suisse, HSBC, and BNP Paribas fell 3.2 to 5%. Concerns are increasing that in a climate of negative interest rates and prolonged dovish monetary policy, banks' profitability will be squeezed. Weaker investment sentiment has been accentuated by the Bank of Japan's decision to apply negative interest rates on excess reserves, which follows moves already taken by the European Central Bank, Sweden, and Denmark. A high level of unprofitable loans on banks' balance sheets impacts the broader economy by stifling both domestic demand and bank lending growth. Stocks fall after jobs report of 151,000 new jobs below expectations. Be defensive. One of 9 sectors moved higher on Friday. XLU, XLP, and XLI were the strongest sectors, while XLY was the weakest sector. Oil fell 69 cents to close at 31 even. Breadth weakened as decliners led advancers 3.23 to 1 on the New York Stock Exchange and 4.5 to 1 on the NASDAQ. The SPY was down 3.65 at 187.95 on 180.7 million shares, 15% above average volume. The NDX fell 143.3 below last week's support low, led by Amazon, Microsoft, Facebook, Google, Intel, Amgen, and Adobe, which combined for minus 53 points on Friday. In 2015, the QQQ led the SPY and the Diamonds. With Friday's sell-off, QQQ is now down 10.5% year to date, significantly underperforming the SPY and the Diamonds. On Friday, 27 NDX lost 5% or more. Stocks below support should generally be traded bearishly until a bearish reversal or bullish reversal pattern forms, I should say. 9 Dow stocks, Merck, Verizon, Walmart, IBM, Procter & Gamble, Exxon, Caterpillar, PGE, and 3M rose on Friday. This was in contrast to only 7 NDX 100 stocks that rose on Friday. Your Dow stocks are typically your more defensive, dividend-paying. So in market weakness, you'll see rotation going from the technicals and the broader markets and focusing down into these large cap defensive holdings. Only 3 sectors, XLB, XLU, and XLI, rose for the week. XLB Materials was led by weekly gains in Dow, DD, Monsanto, ABD, PX, LYB, and IP. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6 o'clock a.m. Central Time, and I'm recording this in preparation for the market day of February the 8th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And you notice on the morning reading, I flipped in a little bit of news from the overnight session, not just from, Friday's close. And that's because, once again, we have a pretty significant drop-off. And if you notice, when we get to the charts and we start looking at the influence from Europe coming in, that about 3 o'clock Central Time is when there was a decided drop, and it lasted for about an hour, and that's where most of this has come from. And the S&P futures were down over 1%. Russell futures at the time of this cut also down a like amount. NASDAQ even more, down 1.73%. Dow's down about 1.25%. Crude oil down about 2.5%. The euro is down about 0.19. Bonds are up about 0.4, and gold is up about 1.5%. In overseas action, China down about 0.2%. Hong Kong going the opposite direction, up about 0.5%. Japan up about 1.1%, while Europe seems to be the largest influence in what's going on in our own markets. Germany in particular down about 2.33%. United Kingdom down about 1.5%. In terms of macroeconomic reports for today in the United States, there really is nothing to speak of. One orange flag report that points to mortgage delinquencies, and that is actually, it's slated for sometime this week, so we don't even have a specific time on that. So really nothing that is known to be reported today in the U.S. macroeconomic report section. Looking ahead for tomorrow, we got a yellow flag report. There's JOLTS job openings. So pretty light at the beginning of this week. In terms of current volatility conditions, see the short-term VIX about a 23, a little bit up on Friday. Skew, though, is in the non-warning area. So in contrast to where this has been quite a bit in recent weeks, this has actually dropped and ebbed somewhat. Also in IV percentile, relatively middle of the range. You got a 39 in the S&P. The Russell, I should say, is a 50. The NASDAQ of 49 and the Dow of 44. You did have multiple standard deviation moves put in on Friday, and the Russell and the NASDAQ had 2 standard deviation moves, followed by 1 standard deviation moves on the S&P and the Dow. In terms of the charts, let's go there. I'm using the S&P futures because of this overnight activity, and you look a little bit closer at our most recent activity, you can see we are breaking down in this overnight. We're up off the very lows, so obviously there's still 2.5 hours to go from the time I'm recording this to the time the cash market opens. We'll have to see what happens between now and then further we'll have to see what happens when all the market participants come together, and do they support this area and retrace some of this big down move. But right now we're still down over 23 points as I look over my shoulder to see the live data. If we indeed follow through with this, whether this is a complex bear flag pattern or if it's simply a break of the diagonal support, either way, it doesn't matter. It's broken, and we're likely in this pattern, maybe not, in a day or two, but at some point in the near-term future, it would seem that this pattern would take us down into finding support somewhere around this 1800 area, which was our previous swing low back in late January. So going to be pretty interesting to see if we can find any support anywhere prior to that. You might find it around 1830, which was this level here back from August. That might prove to be a little bit of support. You had a bottom here, you had a bottom here, but that's a fairly tenuous area. More likely we'll just simply find support just because we come into an area where we have some exhaustion on the current day selling. Not likely, of course, to get all the way down to 1800 area in a day. That being said, your short-term expectation at this point should be bearish until proven otherwise. This is a pretty tenuous pattern, and there's not a lot for the bulls to kind of grab onto. The one thing I will say about this, though, is that we're just still in a range, and we've talked about this over and over again in recent months, and anything between this 2132 area up here where the former highs were, or the 2110 area where you've had the more recent highs, and the low of 1804, yeah, that's a 200-point range, but you look at it, we have repeatedly just swung from one side to the other of this range, and until you expand that range, you are essentially in a range. And while we're near the bottom of the range, it is when you're near the bottom of the range that you often see reversals come in like you did here. This one didn't even make it down to the August lows on the S&P. Now the Russell did undercut that, but bottom line is it did find support and then swung back up, and the primary direction of our current market is frankly that of a market in transition, a market in a range and choppy and increasingly volatile character. And yet at the same time, it's not necessarily all out bearish, nor is it by any means all out bullish. So don't get too heavily loaded up one side or the other. If you're trading short-term patterns, that clearly is to the downside at this time. In terms of other patterns, just a second here. In terms of other patterns, you see the NASDAQ here, a very ugly overnight pattern, and we are approaching those August lows. And the Russell, I mean, we're below almost everything except the most recent low of January the 20th. And then finally, let's take a look at the Dow. Dow actually, as we saw from the morning reading, and Friday actually was holding up a little better than the others. There's been some rotation from these other sectors into these Dow 30 stocks, as they are thought to be something of a more safe haven status and still paying a dividend. But that doesn't mean that they won't fall also. They certainly will fall if the market gets strongly bearish. Let's take a look at bonds. And speaking of where might people be going, well, bonds, of course, are looking to extend this recent run and this recent break of resistance. And while we had a bit of a pullback for a day, that has already set up into a bull flag breakout. And now we're looking to exceed the former highs of just 2 or 3 days ago. We are likely, if the market continues to be weak, on bonds going to head to this 166, 21, 30 seconds area. We'll take a look at that on the tilt, the ETF. As this opens up, I would expect that we would see probably a bit of a gap up, and again, probably moving up towards this 132 and change area on the long bond ETF. And I think that's probably enough with the charts today. Let's go ahead and get to the daily report. And this continues to become ugly. We've been back into phase one on the market trend intermediate term phase opinion, basically bear flag territory. And the characterization is toe in the water, selling puts and reduce stock positions if you're initiating any new positions at all. In terms of the portfolio investor posture, we did have further breakdown here. We have had uptrend under pressure now called by IBD. So that makes the 13th confirmed uptrend in a row in some 13, 14 months now that I've been following that system during this chop zone that has failed to follow through to any kind of significant kind of bullish move. So these very much range-bound markets continue to kind of chew up these signals. Accumulation distribution, S&P is deteriorated to a D-. NASDAQ also to a D-. GMI index has been very consistent through all this. It has been a 0 out of 6 and has been in a full-out sell signal since 1210, and that author has been 100% in cash throughout all this mess in recent weeks. Decision points scoreboard, I did update this, and you'll notice that the NASDAQ, that one lone green signal that was there has now broken down and is down. So very, very tenuous effort on the short-term signals to show something of a bullish posture, but really the primary direction here, and indeed as we look for consensus across these various mechanical signals, is decidedly bearish. In terms of position sizing opinions, you see a reduction now in the long side portfolio exposure going to 50%, and from a volatility signal also at 50%, so very defensive there. Intermediate term market posture has gone to very bearish with a very bearish sentiment line. So everything is rolled over here with Friday's action, and you see 36, 37, 23, 25. If NASDAQ drops below a 20 today, that will go to severely bearish, and the same thing with the Russell. So not a pretty picture in terms of the intermediate term market posture. Hedge warning status has increased today to a level 2. We call this our yellow light. So as you're approaching that intersection, the analogy is you see the car in front of you starting to hit the brake lights. You should be very, very careful about proceeding forward with any kind of bullish activity in this kind of a market environment. As a hedge risk level 2, the probabilities of, though not the certainty, of a significant down move are greatly heightened. We're not predicting a down move, nor are we predicting a move of a certain distance. We're just simply saying that the probabilities and the conditions for such a situation are dramatically increased over the lower levels of 0 or 1 or even 1+. When you go down to the specific warnings, market in decline, sharp increase warning, VIX futures up over 18, NASDAQ, though this is not quite to warning status yet, at 5 it becomes a warning status. We took very little time to accumulate 4 distribution days on the NASDAQ, and certainly that is quite concerning, and that could go to full out warning status with one more session. VIX phase is increasing. The current week out expected move in the SPX was a 55 over the weekend, and that could expand with today's open if we indeed do drop and open some 20+ points down. On terms of the intermarket risk aversion indicators, we've got 3 of the 5 now as risk off, and the other 2 that are still in risk on status, but they're rolling over, and that situation could change, and we could see all 5 of these as risk off in another day or 2 if this weakness is continued. Fear and greed index is down to a 19. This had been improving. A week ago it was a 26. Most recently was a 25. Back down to 19. So extreme fear in the fear and greed index. In terms of special opinions, option income strategies, the VIX is outside the acceptable window to initiate new positions for novice traders. Covered calls and put selling conditions also not acceptable to initiate new positions for novice traders. If you're a very aggressive trader, obviously there are some opportunities with this increased premium, but be very, very defensive and selective, and certainly consider that position size, especially with put selling. Keep that position size in the scale that you are willing to own. In terms of sector specific, you see we've returned pretty much to that sea of red, with the one lone exception of utilities holding up in all 3 time frames. Again, a very defensive sector. Sector percent change, only utilities and telecom of course is another area where, well, first of all, there's only a handful of companies in the telecom, and they're generally expected to be relatively defensive in nature and often looked at for their dividend yields, and you see their returns along with utilities with much the same characteristics are holding up quite well in the year to date and all the time frames. So this is a very defensive rotation. In terms of the relative rotation graph, again, where are you finding good direction heading up into that upper right quadrant? It's utilities and it's REITs. So people are seeking dividend yield and consistent income in this time of market weakness, and everything else that would be looked at as more of a perhaps normal holdings is getting pretty much pummeled and is falling into the bottom left quadrant, the opposite of where you want things to go. Okay, I think that's probably enough for today, and we're at 20 minutes. I don't like to go over that. Remember, one of the things, and we'll talk about this right here, is with YouTube, you can subscribe to that channel. If you find what you're getting here is helpful to your trading, you can go to this hyperlink and then subscribe to the channel, and that'll give you an email that will alert you that new content has been posted so that you can get to that as early in your trading day as you find convenient. The other thing about that is that you don't have to take 20 minutes to listen to this in the morning. You can hit the little gearbox that is on that page, and when you hit that gearbox, that gives you the opportunity to do two things. One is to change the recording to play back to you in high definition, and that's particularly helpful when you're looking at charts and the like. And the second thing is that you can change the playback speed, and I would suggest you try 1.5 the normal speed, and that would cut that 20 minutes down to about 13 minutes, and at 13 minutes you'll find that you should generally be able to still understand everything and yet cut that time to your morning down to a point where perhaps it's a little easier to handle. So I'm going to just flip through the rest of these slides. We don't have any more time for today. If you have an interest, just hit the pause button and go to the hyperlink and get additional information. Disclaimers, as always, hit the pause button if you need more time to review the disclaimers, and you see the full hyperlink down here that takes you to the full set of disclaimers. We'll see you back here tomorrow morning for the Falcon Global Market Preview. Good trading.